Hi everyone, this is Jason Barrick of Wall Street from Main Street. Normally I will not do short videos this frequently, but if we get noteworthy information coming out with a number of news stories that I think is important to you guys and it's important to the global economy, I will do a short video based on a story or two that I think catches my attention that I think is important to you guys. Okay, so one of these stories came out yesterday, but it was actually updated this morning again. Fed admits another $4 trillion in QE will be needed to offset an quote-unquote economic shock. So in a Fed staff working paper released over the weekend titled Gauging the Ability of the FOMC to Respond to Future Recessions, penned by the Deputy Director of Division of Research and Statistics at the Fed, the author concludes that simulations of their models show that they will need to do enormous amounts of bailouts or QE and potentially double the size of their balance sheet in a worst case scenario to $4 trillion, an increase of $4 trillion. So the Federal Reserve's balance sheet is already $4 trillion. They mentioned different scenarios here where, well, we might only need to increase the balance sheet by $2 trillion. In a worst case scenario, we'll need to increase the balance sheet by $4 trillion or double the balance sheet. This was really funny because we hear a lot of the mainstream financial media and a lot of the mainstream people on Wall Street who are Keynesian, they keep repeating, oh, interest rates will eventually normalize. Oh, the Federal Reserve will be able to reduce its balance sheet. And we see here from the things emitted in this paper, that's not going to happen. The Federal Reserve is not going to be able to reduce their balance sheet, and most likely they're going to have to increase their balance sheet. Okay, so I want to talk about some of the delusions that the Federal Reserve have. They are totally divorced from reality. These guys believe in their models, even though their models are wrong. Their models have very subjective inputs in there, garbage in, garbage out. And in a lot of cases, they already have the end conclusion they want when they design a model. And these people are so divorced from reality, so delusional, that, you know, the Federal Reserve even made a Facebook page and it expected nice people to comment on there. And congratulations to you guys coming up with good, poignant comments on there. You know, this is a case of good trolling where you're speaking the truth to authority. You don't have to, don't call them mean names, don't threaten them or anything like that. That could get you in jail. Just be polite and tell them what they've been doing wrong. Okay, I mean, you don't want to put a threat on there and have it captured because people go to jail for felony threats and stuff like that on Facebook. So don't do that. But by all means, tell them that, you know, they're creating serfs with inflation and taxes, and they're destroying the value of the dollar and things like that. So go to the Fed's Facebook page if it's still there. This is just as bad as that Ask JP Morgan thing that they did, and people were asking them about manipulating gold and silver in the commodities markets and things like that. So these guys are delusional. Okay, so we got an interesting question from Lorenzo. He comments on the Wall Street from Main Street Facebook page often. I don't know if that's your real name, Lorenzo, but you seem like a nice, smart guy. So I told you I will address this in a short video today. Some of the original people who started Zero Hedge, I've actually spoken with one of them on the phone at length. He's no longer there at Zero Hedge, but he was working there early on for a year or two. And he was initially an assistant producer at CNBC, and initially, the reason Zero Hedge started was because the mainstream financial media, so CNBC and Bloomberg, they had tons of information and sources leading up to the 2008 financial crisis about subprime housing, the housing bubble bursting, the derivatives problems with AIG and Bear Stearns and Lehman Brothers and the other mortgage-backed securities, the problems with the banks. They did their best to hide a lot of these stories. So a lot of these stories were intentionally not reported in information. So the sponsors, the paid sponsors of CNBC and Bloomberg, a lot of them are either the large banks or they are mutual fund companies that sell stock funds and mutual fund, stock mutual funds and bond mutual funds. Take a quick swig of water. And so what I was talking with this guy about was, you know, they had all this information and, you know, they just got fed up. He was an assistant producer there. So he would see the stories and the information and people would be giving him stuff. And then the producers and the other advertisers who would go above them would just kill the stories. So they got fed up, and that's how Zero Hedge was starting. The Bloomberg article that outed the people on Zero Hedge last year, those are the owners of Zero Hedge. Those are the people collecting the checks. Those are not necessarily all the people gathering the sources and the information. Those weren't all the original posters. Those are the guys who fronted the capital to pay the salaries initially for some of these guys or part-time work and things like that. Initially, I think a lot of the people, though, were not getting paid at all on Zero Hedge. They're just doing it to help people. Let me show you give you an example of how powerful Zero Hedge is. If you work for an investment bank and you tip Zero Hedge, and they have software now that can check if you looked at the Zero Hedge website on your computer, or you sent an email to Zero Hedge from a private email account on your work computer, you can basically be fired immediately. They may even be able to sue you. So Zero Hedge is viewed as a powerful whistleblower in the industry, and it's one that the mainstream financial media and the large banks and the Federal Reserve and the government are scared of. The Federal Reserve has even tried to deny Zero Hedge stories in the past, especially the one last year where Zero Hedge had good sources that the large banks were refusing to default on oil loans. So they are scared of Zero Hedge. Now, not if you read these comments here, not everything Zero Hedge is 100% the truth. It's close, though. So not everything's going to be fully accurate, but it's overwhelmingly accurate compared to the mainstream financial media. A lot of the stories, guys, in the mainstream financial media are intentional lies. They withhold information to say, oh, stocks are going to be good, or oh, there's no inflation, or oh, look at those great jobs numbers, or they're outright propaganda where they're, not challenging any of the government numbers for the data, for so many different government statistics. I just wanted to mention a few more things besides the Fed's ridiculous Facebook page showing you how delusional they are in the comments here. This article, though, obviously this is on balance sheet. So if the Federal Reserve doubles their balance sheet on balance sheet to $8 trillion, that wouldn't count the off-balance sheet currency swaps, which we know are exploding from my own sources for a while now. Andy Hoffman, who did this article yesterday, I couldn't be angrier or less worried. He mentioned something interesting towards the end. Heck, San Francisco Fed President John Williams started 2016 by predicting 3 to 5 rate hikes, which have not happened, but last week advocated negative interest rates in the Fed minutes. He was talking about the U.S. should have negative interest rates at private banks, and also a raising of the Fed's 2% inflation target and targeting of nominal GDP as an official Fed policy. Now, we've gotten responses from people that, oh, you're only citing conspiracy theory tinfoil hat websites. Okay, well, let me show you guys something. We are now on the Federal Reserve Bank of San Francisco's website, where we have an article directly written on August 15th by John Williams, which is what Andy Hoffman was quoting. Monetary policy in a low R-star world. I'm not sure what R-star is. I think it could be some Keynesian gobbledygook. Maybe it's an econometrics term. I'm not exactly sure what it is. It's not a basic financial term. It's sophisticated stuff. But he basically, if you go through and read this article, actually he talks about R-star. First and foremost, the natural rate of interest, or R-star. I don't even know how they calculate the natural rate of interest. The natural rate of interest is set by the free market, and there's a real inflation rate counted. So obviously they're not counting the real rate of interest. It's probably a bunch of their assumption models. Okay, basically he talks about how they need to go to negative interest rates for the most part, and how they're not getting enough inflation. If you read this whole article, or at least read the last couple paragraphs or so, he talks about how they need to do nominal GDP targeting and they need to do inflation targeting because there's not enough inflation. So welcome to dystopia, guys. We're in a scenario where, we're already well over 180 billion per month in quantitative easing, and that is just from the Bank of Japan and the European Central Bank, or ECB. That's not counting the Federal Reserve. So, the Federal Reserve looks like it's going to start expanding things again rapidly too, because there's just not enough inflation. Well, tell that to the people on Main Street whose standard of living, their incomes are being destroyed with inflation and taxes. Their wealth is being redistributed. They can't find a high-paying full-time job for the most part. They're lucky if they can string together a couple of part-time jobs and have a halfway decent life that way. So the people in power are totally delusional. They're looking at their stupid models. They say, oh, deflation is the enemy here, and they want to increase inflation even more. These are not tinfoil hat websites. This is directly from a paper from John Williams of the Federal Reserve Bank of San Francisco. I will attach a link to it, guys. And welcome to dystopia again, because it looks like the Fed is planning on doubling the size of its balance sheet here in the near future, because it looks like they're preparing and leaking it out there for a crisis.